Okay, let's dive into this explainer and solve a massive financial mystery that literally caught Wall Street completely off guard this morning. We're basically looking at a classic economic whodunit here. Incredibly positive news somehow triggered an immediate, massive market sell-off. So let's piece together exactly why the market threw a huge tantrum over what should be an absolute win.
The story starts right here with this number. First thing this morning, we got a stellar U.S. jobs report. The economy added a massive 172,000 jobs in May, totally crushing expectations of roughly 80,000. Meanwhile, the unemployment rate held perfectly steady at 4.3%. Now, more people working means more income and more spending. On paper, this is exactly what you want to see.
But instead of celebrating this incredibly healthy labor market, investors just panicked. The markets absolutely tanked, with the Nasdaq plummeting nearly 5% in a single day.
And right at that exact same time, the VIX, which is basically the stock market's ultimate fear gauge, spiked a staggering 39%. Literally a morning of stellar economic data vanished into a day of sheer panic.
So what does this all mean? We have this crazy paradox. What killed the rally when the economic data was so fantastic? Why hit the panic button over great employment news? Well, to understand it, we need to dig a little deeper. To find our culprit, we actually have to look away from the flashy, entertaining stock market. Stocks get all the attention. But if you really want to know the true engine of the economy, you have to look at the bond market. Section 1. The overlooked bond market. Almost immediately after that blockbuster jobs report dropped, the bond market reacted aggressively. Treasury yields across the board just shot upward. The 2-year yield rose sharply, the 10-year jumped to multi-week highs, and the 30-year followed right alongside. But why did great job numbers cause bond yields to spike like that?
Section 2. Federal Reserve Rate Expectations.
Okay, to really get why yields spiked, we need to talk about what investors were hoping for before this morning. For most of this year, markets have been desperately looking for signs of a gradually cooling economy. Not a recession, right, but a slowdown just strong enough to ease inflation. The hope was that a cooling economy would give the Federal Reserve the room it needs to lower interest rates, which is fantastic for investments. But this morning's report, it threw a massive wrench into that entire narrative.
And this brilliantly illustrates the brutal chain reaction that followed. Step 1, a massively strong jobs report means more income. Step 2, more income equals more spending, which gives businesses pricing power and drives wages up. This creates what we call sticky inflation. Step 3, with inflation sticking around, the probability of the Fed actually cutting rates drops significantly. And finally, Step 4, that leads directly to expectations of higher interest rates for a much longer period of time.
Section 3. How bond yields actually work.
Now, this completely dispels the myth that bond yields just blindly follow the Fed. They're actually driven by expectations of the future. And there's a strict inverse relationship here you've got to understand. When investors suddenly believe interest rates are going to be higher for longer, like they did today, the price of existing bonds falls. And when the price falls, the yield automatically goes up.
Let's put this into perspective. Imagine you own a bond paying a 4% yield. You're super happy with that, right? Until this stellar jobs report hits. Suddenly, the market expects future bonds to offer a 5% yield just to compete. Nobody is going to pay full price for your older 4% bond when they can just wait for a 5% one. So demand drops, the price falls, and its relative yield shifts up to match the market.
So to be clear, investors weren't actually upset about people getting jobs. Obviously, a healthy labor market is fundamentally a good thing. Instead, they were reacting mathematically to a harsh reality. A strong economy means those highly anticipated interest rate cuts are going to be delayed. The market had aggressively priced in rate cuts, and today they basically had to desperately unprice them.
Section 4. The Global Ripple Effect. Now you might be wondering, why should I care about Treasury yields? Well, because the bond market dictates the cost of money for absolutely everyone. It matters far beyond just the trading floor. When yields rise, it creates this massive, undeniable ripple effect. For home buyers, it means higher mortgages. For corporations, it means increased financing costs. And for the stock market, investors have to downwardly reassess stock valuations, which is exactly why the Nasdaq shed 5% today.
As we wrap up this explainer, it leaves us with a fascinating tightrope walk to consider. The economy is adding jobs at an incredible pace, but that very strength is keeping the cost of borrowing painfully high. So, what exactly is the right move for the Federal Reserve when Main Street's gain becomes Wall Street's pain? Should they prioritize crushing the last bits of inflation or step in to protect market growth? It's a massive puzzle, and how they solve it will absolutely dictate what happens next. Thanks for joining me, and I'll catch you in the next explainer.